Welcome back to the deep dive. All right, today we've got a clear mission. We're diving into KeyCorp's third quarter 2025 earnings review. And look, we're not going to make you wade through hundreds of pages of financial reports. We want to quickly pull out what's really driving their performance lately, and maybe more importantly, figure out the actual roadmap they're setting out for the next few years.
Yeah, that's exactly what we need to break down for you today. I mean, the materials we looked at, they really paint a picture of deliberate momentum. It's quite clear. What strikes me is how clear it is. These aren't just accidental wins, right? They're seeing real, tangible, positive returns from specific choices they made last year. Optimizing the balance sheet, really focusing on those high-margin revenue streams.
And the headline story here, it's really one of aggressive growth. When you look at their adjusted revenue, I mean, it jumped 17% year over year.
Yeah.
That's a massive surge. To see growth like that, it kind of suggests they didn't just, tweak things slightly. Feels like they fundamentally changed how the car is being driven, and that's driving these major profitability gains.
It absolutely does. It's the kind of quarter where you really want to look under the hood, see the mechanics. So let's maybe start with those hard numbers, the ones that define that profitability.
Okay, let's kick off with the most traditional measure, earnings per share. Reported came in at $0.41. Now, when you adjust for the one-offs, that's actually a 17% increase just from last quarter. And an even more stunning 37% jump compared to last year. Seeing a rise that steep, it really suggests they must have fixed some fundamental, inefficiencies maybe from the prior year's model.
That's absolutely right. But, if we want to gauge the real long-term health and efficiency of a bank, we really need to look beyond just EPS to the return on tangible common equity, or ROTCE. That's the crucial metric, the one that tells you how well they're turning shareholder capital into actual profit.
Right. And where did that number land for Q3? What was the ROTCE?
It hit 12.5%. And just to give you some context, 12.5% is a very strong number, especially for a regional bank like KeyCorp. What's maybe even more impressive is how fast it improved, that figure. It's up a substantial 168 basis points compared to the same quarter last year. That shows some powerful efficiency gains, a real tightening of the ship, operationally speaking.
Okay, so that 12.5% figure, that really brings us to the aha moment, I think, for anyone looking at KeyCorp right now. These results, they aren't just celebrating one good quarter. They feel like confirmation. Confirmation that the path they're on lines up directly with where they've said they want to go.
Precisely. Management's been crystal clear about their medium-term goal, hitting 15.0% or better on ROTCE, and they're not being shy about how they plan to get there either. It's basically a two-pronged approach. Continued balance sheet optimization, which, we should definitely unpack next, combined with speeding up momentum in those high-margin fee businesses.
Okay.
So these Q3 results, they're strong evidence that they are firmly on the runway towards that, let's be honest, pretty ambitious 15% plus goal.
Okay, now, net interest income, NII. In this kind of economic climate, getting consistent NII growth, it's tough, right, with all the rate volatility.
Yeah.
Yet KeyCorp saw NII jump 24% year over year and 4% quarter over quarter. Their net interest margin, the NIM, expanded to 2.75%. So how much of this margin expansion is them actively cutting costs versus, maximizing returns on their assets?
It's a very tactical mix, actually, and the materials detail three very deliberate tailwinds. So on the cost side, they've done a remarkable job managing their funding. Their total deposit costs actually declined by 2 basis points down to 1.97%.
Wow, declined. That suggests really sticky client deposits, which is essential right now. Are they seeing much leakage, funds chasing higher yields elsewhere?
Not significantly, it seems. Their average deposit base actually grew 2% quarter over quarter. And that was mainly driven by seasonally higher commercial deposits, which, tend to be stickier. Yeah. And here's a little technical piece that matters a lot for future profitability. Their cumulative down interest-bearing deposit beta is sitting around 55%.
Okay, hold on. 55% deposit beta. Let's translate that financial jargon for everyone listening. What does that mean in plain English?
Right. It's crucial context. So the deposit beta, it measures how much a bank's deposit costs change when the Fed changes interest rates. A 55% down beta means that for every dollar interest rates might drop in the future, KeyCorp effectively keeps about 45 cents of that benefit. It doesn't have to pass it all through. It really shows the strength of their client relationships as acting like a significant buffer against potential future rate changes.
That's a really powerful structural advantage to have baked in. Okay, shifting over to the asset side now. The second driver of that NIM expansion seems to be just maximizing the yield on everything they own, right?
Exactly. They're basically harvesting the benefits from the fixed rate book they already hold. Assets and securities they bought when rates were lower are maturing now, and they're being reinvested or repriced at today's much higher yields. The effect is pretty substantial. The materials actually point out that if you excluded the impact from their hedging programs, the protective hedges, their actual loan yields would have been 5.87% in the quarter. So they're actively positioning the portfolio to capture this current rate environment.
And that active positioning, it extends to the makeup of their loan book itself. While the overall average loan total only nudged up, 0.5% quarter over quarter, there's this really interesting trade-off happening inside the portfolio.
Yeah, and it's a perfect example of focusing on quality over just sheer quantity.
Yeah.
They saw strong, focused growth in commercial loans, particularly C&I commercial and industrial. That's up 5% just since the start of the year. And this is, high-quality relationship-based lending. Crucially, that growth is deliberately offsetting a decline they engineered in the consumer loan category.
So they're essentially swapping out assets, aren't they?
That's a perfect way to put it. They are executing what they call an intentional runoff of lower-yielding residential mortgages. This is clearly a strategic choice. Shed the lower-quality, lower-reward consumer stuff and funnel that capital into stickier, more profitable business relationships, the kind that also drive that fee income we're about to talk about. It's a very calculated trade-off. They sacrifice maybe a tiny bit of loan volume growth, but they get a significant lift in the overall profitability of the portfolio. And that lines up perfectly with that 15% ROTCE target we mentioned.
Right. So if the first part of the strategy is all about that kind of surgical optimization in the balance sheet, the second half is definitely this accelerating success story in fee-based income. And that diversification, it's key for stable, high-margin revenue, right? Adjusted non-interest income was up 8% year over year. That shows they aren't just relying on lending spreads anymore.
Absolutely. And the diversification is working really well, especially in wealth management. Trust and investment services fees, up 7% year over year. And this wasn't just the market lifting all boats either. It was driven by positive net flows, so new money coming in on top of the higher market levels.
And that combination, that led to a pretty huge number they just hit, didn't it?
It did indeed. They hit a new record for assets under management, AUM, reached $68 billion. That's up 11% year over year. That kind of organic growth is exactly what you want to see. It builds a predictable, less volatile revenue stream that isn't quite so dependent on day-to-day lending activity.
Okay, now let's talk about maybe the flashier side of the fee business, investment banking. Investment banking and debt placement fees were up 8% year over year. They had this figure that just jumped out at me. They raised $50 billion of capital for clients during Q3. Now, that sounds massive. Is that standard for a bank this size, or is that genuinely an exceptional quarter?
It's a very robust figure, yeah. It definitely signals a strong pickup in debt and equity issuance activity, and KeyCorp is clearly winning business there. But the context of that $50 billion is important. They only kept about 15% of that capital on their own balance sheet. And that's the crucial distinction here. They're primarily acting as an advisor, an intermediary, which is a high-fee business, rather than just using their own balance sheet to hold all that risk. That lets them keep their capital relatively light.
Ah, okay. That explains why those efficiency metrics, like ROTCE, are improving so fast. They're generating high-value revenue without necessarily growing the underlying risk-weighted assets at the same pace. Makes sense.
Absolutely.
Yeah.
But, success does have a cost, and we see that reflected on the expense line. Non-interest expenses increased 7% year over year. That increase, though, it doesn't look like inefficiency creeping in. The materials are explicit. It's tied directly to personnel expense, up $72 million. And that's predominantly related to incentive compensation.
Yeah.
Basically, they're paying out bonuses because those high-margin fee generators in banking and asset management are doing spectacularly well. It's kind of a virtuous circle, right? Success, funding future success. And they also mention they're continuing necessary investments in technology to keep this pace up.
Okay, so given all of this, aggressive management, this strategic shifting into potentially faster growing commercial loans, we need the financial health check. We have to know the institution itself is stable. So what are we seeing on credit quality, the safety buffer?
Well, the health metrics look pretty sound, actually. Credit quality remains stable, even improved slightly in some areas, which kind of defines some broader economic worries you might hear. Non-performing assets, NPAs, they actually declined 5.5% sequentially. So the ratio is tight at 0.63% of loans plus ORIO. Criticized outstandings also declined from the previous quarter. It suggests that strategic shift in the loan portfolio is indeed focusing on solid, higher quality borrowers.
And what about net charge-offs, NCOs? Are losses ticking up?
NCOs relative to average loans held stable at 42 basis points. 42 basis points. And that's smack dab in the middle of their maintained full-year guidance range, which was 40 to 35 basis points. So credit performance is looking highly consistent. That signals pretty excellent risk modeling on their part.
I did notice they released some reserves this quarter. That usually suggests management is feeling, well, pretty optimistic about the future, doesn't it? Is that a fair read here?
Yes, I think that's fair. The materials show they recorded a $7 million allowance for credit losses release, ACL release. And the reasoning they gave was based on what they called a relatively stable macroeconomic outlook and consistent loan portfolio performance. So yeah, when a bank chooses to release reserves instead of building them up, it implies management has pretty high conviction in the stability of their current asset quality and maybe minimal expectation of a severe downturn hitting them soon.
Okay, finally, let's look at capital strength. How robust is their cushion, against unexpected shocks?
The capital position looks excellent. The main regulatory number, the Common Equity Tier 1 ratio, or CET1, stood at 11.8%. That's a strong 100 basis point improvement year over year, and it's comfortably above the regulatory minimums. But the report also shows a more conservative measure, the Marked Common Equity Tier 1, which includes the AOCI impact.
Right, explain that one for us quickly. What's AOCI and why does including it matter so much?
Sure, AOCI stands for Accumulated Other Comprehensive Income. Basically, when interest rates move, the market value of a bank's bond portfolio, the stuff they plan to hold to maturity, fluctuates. AOCI captures those unrealized paper gains or losses. So including it in the capital calculation, which KeyCorp voluntarily reports, is the most conservative way to look at their actual capital cushion. It reflects current market reality. And even by that stricter measure, it improves significantly to 10.3%. That's up about 170 basis points year over year. So, long story short, they have ample capital, enough to support future expansion and navigate potential volatility. Hashtags down outro.
So wrapping this up, this deep dive really confirms that KeyCorp's Q3 2025 results, they're a clear validation of successful strategic execution. The performance seems fundamentally driven by the successful balancing act, optimizing the loan book to catch those NII tailwinds, while at the same time expanding those high-margin capital-light fee businesses. It's working.
And that successful execution, it's reflected right in their updated guidance. They now expect net interest income to be up around 22% for the full year 2025. And they're guiding the net interest margin slightly higher for the fourth quarter, too, targeting somewhere between 2.75% and 2.80%. The momentum is undeniably strong right now.
Okay, now for that provocative thought we like to leave you with. Management sounds highly confident they'll hit that 15% or better ROTCE target within the next few years. And a lot of that confidence seems based on tailwinds like fixed-rate assets, repricing higher stuff. They already kind of have baked into the plan. So if the market has maybe already priced in that expectation of 15% ROTCE, what's the next big catalyst KeyCorp needs to find or create? Maybe a massive tech-driven cost saving, an unexpected M&A opportunity, something else entirely to truly accelerate performance beyond that 15% and justify an even higher valuation down the road. Maybe watch the strategy, not just the numbers hitting the targets.
That's the real question, isn't it? What comes after the target is met? Keeps things interesting.
Absolutely. Thanks for joining us for the deep dive.